Hi, everyone. Thank you for joining us today on our episode 2 of Coalition Conversations. Today, we're going to be talking about the broken tax system and is it hurting American domestic businesses? I'd like to welcome my guest, David Morse, the Tax Policy Director of CPA. David, thank you for coming on. In addition to all of your great work within the tax field of research that's been highlighted and featured in areas such as tax notes, you've once again, for the fourth year in a row, been deemed by Forbes as one of the top must-follow Twitter accounts for 2021. David, you're a big advocate for alternative tax system for federal corporate taxes. When we start looking at the economic implications and the revenue streams that the federal government is losing out of because of these multinational companies paying such a smaller portion of their tax fees, what does that mean for small American domestic companies? What's going on there?
Well, the simplest way to explain it is that the domestic companies are being undercut by multinational corporations. Now, these are both foreign and American multinational corporations. They engage in what is known as profit shifting. So they move their profits around so that on paper, at least, they can say, oh, I didn't actually make that much money in the United States. I made it somewhere else, say Bermuda, which has a 0% tax rate.
So does that kind of allow for like a tax loophole for these large corporations?
It's definitely what I would call a loophole. What they like to call it is aggressive tax planning. But in the end, these are only available to them because they have what are known as subsidiaries, parts of their company that they own, but then they can claim are different parts of their body. So it's like saying that I have money in my left hand, but I have none in my right hand, and you can only tax what's in my right hand. It's very weird. Basically, the ability to park your earnings just on paper is something that has been driving the United States and the international tax community kind of crazy for a little while. Right now, there's this big international negotiation that's happening because all the, especially European countries, they want to tax what are known as the GAFA companies. So your Google, Amazon, Apple, Facebook. And these companies, for example, Amazon just came out with their report and they are paying half of the statutory tax rate in 2020. And retailers who are competing against Amazon, they don't get that ability. I'm certain that they would love to be able to pull that same stunt off, but if one side can do it and the other one can't, I would say it's a loophole.
I mean, you just wrote an op-ed in Market Watch recently, and it talked about that complicated tax structure and how the GAFA is kind of manipulating this. But it's not just GAFA that's taking place on this too, right? It's other large companies that are doing this internationally?
Yeah, the digital companies, while they get a lot of the attention, multinationals have been playing this game for a long time. And for example, Anheuser-Busch is one of the most complicated corporate structures in the world, and it's almost all because of trying to move their taxes around. So imagine the craft brewer over in New Hampshire who's just trying to, improve their business, to grow their business, and they have to compete with this huge multinational conglomerate that can pay so much less than them. We recently had a study done of the S&P 500s. Our chief economist, Jeff Ferry, did this. And after the Tax Cut and Jobs Act, we still found that there was just under $100 billion worth of tax revenue that's being profit shifted out of the United States. So that's a huge deal. And that's not counting, that's just the federal revenue. That's not counting the state revenue.
Okay, so this is someone like me who, general layman here, you hear about, the tax havens and profit shifting. Does it have anything to do with like tax differential? And
yes.
How does this affect the American business person that they're paying their fair share? How does this correlate to one another?
Right. So the tax differential is something that is very notable because it's not something that everybody pays attention to. But as soon as they start to think, small business starts to think about what is my competitor paying in terms of a tax rate, suddenly this idea of a tax differential becomes very, very important. So, for example, I would say you take a company, a coffee company, just a company that's an independent roaster or even just a coffee shop, and they're trying to compete with, say, Starbucks. Now, if you have these two different companies and one's paying a much lower rate, and it happens to be the biggest, strongest multinational out there, while the
Who
smaller
could that
company
be?
have to pay that nearly 21%, you suddenly have this huge automatic disadvantage that has been created by our own government unintentionally, but still it's there, and it's not something that small businesses can really compete with unless the government changes how they tax.
Okay, so CPA is known for coming up with some really great solutions, researching them, advocating for them, and bringing them to light and fruition. So the problem is that these multinational companies are really finding these tax loopholes. What is a solution that could come to fruition and be beneficial internationally and on a federal level as well?
So the best solution that we have found that would be most advantageous is the sales factor apportionment. So we're talking about this idea that companies should be taxed on the profits that they earn by selling into the US market. So where they register as a company doesn't matter. It doesn't matter if they claim to be in Bermuda, it doesn't matter if they claim to be in Wisconsin. They will be taxed at the same rate, and they're taxed based on their profits, but based on the sales that they made in the US versus what they made everywhere else.
Okay, so what can be done by those who want to see a fair playing field in respect to taxes being paid then? Knowing that we have this sales factor apportionment, which we also call it as SFA, it's a little bit shorter, correct?
Right. SFA is a much simpler way to talk about it. And the biggest thing that I say would be best would be first to educate themselves, to come and find out more on the prosperousamerica.org. We have a tax committee that meets every 6 weeks, and I'd love to see them there. I'd love to talk to them. So if they want to email me, they can email me at david@prosperousamerica.org. And the biggest thing is to learn exactly how they are being affected. And then once we've heard it said many, many times, once you see it, you can't unsee it. It's just part of how you suddenly realize that the world has been taking advantage of the smaller corporations and giving an advantage to the biggest corporations in the tax code, not counting all the other aspects that exist just because they're smaller and compared to.
I think you froze up on us a little bit there, David, at the end.
Okay.
We didn't hear the last portion.
Oh, sorry. So what I'm saying is that it's just something that once you know that it exists out there, you can't unsee it. The biggest problem that exists is that people don't know, because what small business has really the time always to pay attention to all the intricacies of the international tax code, especially when they don't sell overseas. But once you realize that it's not just what you're not selling overseas, it's what your competitor is selling in the United States and then claiming that it was an overseas sale. So let me give you a quick example of this. Let's do the coffee company. So
Okay.
let's take a dollar coffee cup just for simplicity's sake, and you have the smaller coffee shop that they will spend 90 cents on their costs. So this is their labor, their everything that they need to keep running, and they're going to make 10 cents of profit on that sale of a coffee cup. A cup of coffee.
Okay.
Once that's what they expect, and then once they've made that sale, they're expected to pay the tax rate on their 10 cents of profit. Now, let's flip that over to a multinational who, what they do is they sell the same coffee cup, but this time they go, oh, we're really sorry here, but that 10 cents of profit, that wasn't made in the United States. We have 3 cents that belong to the profits that were made in Bermuda because the shipping company is flagged in Bermuda. It was a Bermudan ship. Then you have the there was some insurance on there for the transport of those coffee beans, and those belong over in Luxembourg. So that's 1 cent over to Luxembourg. And what they do is they take penny by penny, piece by piece to all their different subsidiaries until finally what they report to what they sold in the US is 2 cents to 1 cent of profit in the United States. And then they say, oh, but then we have all these, say, tax credits. And that, so then they can get the advantage of the tax credit on top of it. So sometimes, whether it be bananas or cups of coffee, we end up paying them.
So how much money is the U.S. losing by allowing these tax loopholes and these tax codes to take place without like a proper SFA in place?
So first of all, there's the federal government losses, which, as I mentioned before, was about $97.8 billion is what our most recent study showed. Now, there are other studies out there that have that number higher, and there is some disagreement about where that it finally and is the end result there. But then there's another study that was done on the state level, because the states have many times a sales factor apportionment or some version of apportionment. But what they have is they've also been they were told back in the 80s and 90s that they had to have this extra special rule to comply with the federal government. So that way they would then have to only tax what happened in the United States. Nothing outside the United States counted. So by limiting themselves in that respect as well, they're losing somewhere between 14 billion and 17 billion, depending on the revenue year by year. In terms of, so that's a huge chunk of change, both on the federal level and on the state level.
It's insane that something so big is happening and that there is a solution, but we just have to have that implemented and get that going. What can our viewers that are coming in now, if they want to continue this conversation, they can go ahead and contact you and be able to have a more in-depth conversation, because this is just really breaking off the tip of the iceberg, correct?
Oh yes, this is dipping your toe in just to so that you can understand what is actually happening. But there's a lot more happening on the negotiation side and at the international level, and CPA has been very involved at that international level as well as the state level. We're one of the few organizations that has actively engaged and fought for domestic companies. Almost all the time it is, you do see a lot of academics and experts in that realm, but you see some think tanks, but most of the time you see a lot of multinationals arguing why they shouldn't be taxed any more than they already are, even though they already have this huge advantage. So it's important to have the domestic companies have a voice at that level so that it's understood that right now the game is set against them. So I would say contact me again at david@prosperousamerica.org, or feel free to join CPA and just get on board with the tax committee meetings, and we would be very grateful to have you.
Thank you so much, David, for coming in. Is there anything that you want to mention other on SFA that we haven't really touched base, or can we invite you back on for a more in-depth conversation?
Oh, I'd be happy to come back. The only thing that I would add is, if you really want to understand the SFA formula, it's pretty simple. You want to just look at the total sales of a company, and you want to then look at the sales that happen in the US. It's sales in the US divided by sales that happened all over the world. That gives you your fraction or percentage. So you multiply that fraction to the total profits the company made. So all we're saying is we're not going to tax you on your profits that you made from selling from France to Germany or from Switzerland to Indonesia. But there were sales that you made in the US, and those sales, you made profit off of that. And we're going to simplify the entire measurement so that way you're only paying on the sales you made in the US. That's all we're asking for. And that creates the tax base, and then we apply whatever tax rate we want to that.
Makes sense. And I hope that we make some really great headway in 2021 on the whole SFA Tax Act as well.
Absolutely. There's no full legislation yet, but we're hoping that at some point, both the new administration and Congress will take a serious look at this.
Wonderful. David, thank you so much for joining us discussing sales factor apportionment. Again, if you'd like to go ahead and get a hold of David, please do so at david@prosperousamerica.org. Feel free to leave a comment at the comment box below. We'll be taking a look at those. And then always feel free to go ahead and email myself, melissa@prosperousamerica.org. David, thank you so much for joining me.
Thank you. Pleasure.